Happy Friday to you. Welcome to Business Edge. I'm Esther Awuni. Many thanks for joining us today. On the show, we'll take a deep dive into the ongoing economic reforms in Nigeria and the impact so far on the economy and households in the country. Also on the show today, Zimbabwe is changing its strategy to support its local currency. We'll speak to an economist from the country on the new plan and the country's economic prospects this year. We'll also check in on the markets here in Nigeria, which continues to lose momentum after a strong rally that pushed the index over 100,000 points, making it one of the best performing stock markets in the world so far this year. Well, that's what we have on the show today. But before we get right to our conversations, let's bring you our top business headlines from across the continent. Nigeria's main unions have issued a 2-week ultimatum to the government demanding wage increases, a better public utilities access, and accusing the government of reneging on its promises to cushion reform impacts. The Nigerian Labour Congress and the Trade Union Congress cited rising hunger, reduced purchasing power, and insecurity due to reforms driving inflation. President Bola Tinubu abolished fuel subsidies and deregulated the currency, tripling petrol prices and exacerbating living costs in the country with record inflation. And widespread insecurity has also affected agricultural output, further inflating food prices. The unions demanded action within 14 days without specifying the consequences. Meanwhile, the Central Bank of Nigeria, under the guidance of Mele Kyari, the group chief executive officer, has established a dedicated Department for Managing Crude Oil Sales Transactions. Kyari disclosed that the NNPCL Board of Directors has sanctioned the transfer of a significant portion of the company's revenues to the Apex Bank. This move aligns with earlier directives, including President Tinubu's instructions for the CBN to oversee crude oil sales proceeds. The collaboration between the NNPCL and the CBN aims to maintain safe financial limits and optimize operational efficiency. While reactions to this decision vary, NNPCL assures the public of stable fuel prices and has debunked rumors of an imminent hike and has urged against panic buying. Outside our shores, Liberia's President Joseph Boakai has initiated audits of 3 crucial government entities, including the central bank, as part of an anti-corruption drive, according to a Thursday statement from the presidency. The president, who won the November elections against George Weah, pledged to combat corruption and enhance living standards in a West African nation. The audit extends to the previous government as well. The presidency announced that Boakai tasked Liberia's General Auditing Commission with auditing the central bank, the National Security Agency, and the Executive Protection Service, focusing on the period from 2018 to 2023, which results due within 3 months. This move underscores the president's commitment to fighting corruption and promoting transparency. Well, those are top headlines from across the continent at this time. We'll take a quick break. I'll bring you a market update next. Join us again. Well, lackluster trading continued for another session on Thursday at Nigeria's stock market as investors lost 480.78 billion naira. A market breadth was also negative as the bourse recorded only 6 gainers versus 51 losers, with 61 remaining unchanged. Let's take a look at the numbers now from the market, starting with the all-share index. Now, we've seen investors basically still pulling profits from the market. Now, the all-share index now down to 101 from 102, where it's been in the last couple of sessions, so down 0.86%. Let's move over to the market capitalization. We're still standing over 55.39 trillion now. Let's move over quickly to the session's top gainers. So it's still a mixed bag for the top gainers. We have Mayer, Tantalizer, one of the penny stocks at the market, up 4.7% yesterday. We have Julie, still on investors' radar. The stock has rallied in the last couple of sessions, and investors continue to put this in their basket of stocks. If you see just under ₦1 at the moment, and if this continues, Julie stock could actually make it to the ₦1 mark. We have Red Star Express and Lasako from the insurance sector up 3.5%. Let's go over quickly to the top losers for the session. Another mixed bag here. We'll have two banks here, Unity Bank, Sterling Bank, both down 10% each, and Eterna from the oil and gas sector down 9.9%. So it looks like the market continues to have that wait and see posture for now as more earnings come into the market for investors to see those stocks or those companies that would declare dividend payouts for the full year 2023. Well, that's a snapshot of market trading yesterday. Let's take a quick break, and when we come back, we'll begin our first conversation. Join us again. Well, Zimbabwe is considering overhauling its exchange rate regime as the government seeks new measures to save its troubled currency. The latest proposals will be in a monetary policy statement the Reserve Bank of Zimbabwe and Treasury are jointly working on, according to Governor John Mangudya. Zimbabwean President Emerson Mnangagwa on this week signaled a revamp following the local dollar's decline. Joining me from Harare, Zimbabwe, is Dr. Chitambara, a developmental economist. Thank you so much, Prosper, for taking the time out to join us today.
Thank you for having me. It's a pleasure.
Just to give us, for some context, help us understand the currency slide that we've been seeing, that's the Zimbabwean dollar, and the efforts that have been taken so far. Because at this point, the government obviously believes that those strategies have not been as effective as it would have loved them to be, hence the change of strategy.
Yeah, so what we've been seeing, especially the beginning of this year, has been a massive fall in value of the local currency, which is essentially signaling the fact that economic agents in the economy have actually lost confidence in the local currency. We've seen inflationary pressures resurging, increasing. The January inflation numbers actually show that there has been an increase from December last year. It has also obviously been caused by the plethora of new taxes, as well as the increase in existing taxes that were announced in the 2024 budget and that have already started being implemented. So it's been a challenge stabilizing the local currency and obviously stabilizing the local economy, because ultimately no economy can sustainably grow and prosper in an environment where there is currency instability, because currency instability spawns price and macroeconomic instability. But of course, in the case of Zimbabwe, it's been the loss of value in the local currency has been on account of a number of factors, including unsustainable growth in money supply, as well as fiscal ill discipline, maybe for want of a better word. We have struggled with discipline, whether it's fiscal discipline and monetary discipline, for a very long period of time. And obviously what we are seeing is really probably a harvest of the fiscal and monetary ill discipline that we have sown over the past years and even past months. So it's going to be a challenge really coming out of this situation, because once economic agents have lost confidence in a local currency, restoration of confidence tends to take a bit of time, and it then calls on authorities to implement and sustain implementation of fiscal, monetary, and other institutional reforms in a more comprehensive manner. So I think what's needed is, of course, it's not just the monetary policy response, but also fiscal policy response. And on the institutional side, we need to implement institutional reforms that restore confidence back to the local economy.
Right. Let's talk about options available to the government, particularly, obviously, the central bank. And one of that is scrapping weekly foreign currency auctions, which the government began in 2020. To what extent is this going to help alleviate the situation, and what will be key in ensuring that this option succeeds?
So there are still some distortions in spite of what we have mentioned, that government has made some reforms or has implemented some reforms on the foreign exchange front, but there are still some distortions, which explains why even the National Monetary Fund has been calling on the central bank to fully liberalize or to liberalize to a greater extent the whole foreign exchange management system. I think that will help in terms of ensuring there is greater confidence, and also obviously eliminating the black market, or at least reducing the black market premium. So in terms of foreign exchange management, I think there's still a lot that can be done, especially ensuring that the exchange rate is to a very large extent determined by market forces of demand and supply. And for some observers have been calling on government to do away with the auction system altogether and just allow the market to determine the exchange rate and the management of the exchange rate system.
What is the forecast for the Zimbabwean dollar this year? I know that obviously it has been depreciating, and a number of factors continue to be responsible for that. And where the currency heads next, obviously, will be a function of the success of whatever strategy or policies the government, the monetary authorities take to strengthen it, at least create some stability. But what is the forecast for the currency this year, and how difficult is it to even forecast, in terms of what reasonable trading band it could be at? Yes.
Now, the outlook is not looking very good, especially in the short term. So in the short term, we expect, the currency to continue to take a battering, unless there are very drastic measures that are implemented. But even if the government implements drastic measures, those measures may not be received positively by the market, and that could even exacerbate the situation. So I think what is needed in our current situation is to come up with some kind of a social contract that binds together government, business, labor, and civil society partners to some kind of an agreement on what must be done to come out of this economic quagmire that we actually find ourselves in. Because if government decides to go it alone, that could even weaken or further weaken confidence in the local currency and confidence in the local economy. So I think there's need for some kind of consensus on what must be done, and then we need to implement what we would have agreed on within that social contract framework or platform.
I know this might be a little tricky, but in obviously many economies, I'm not sure this applies to Zimbabwe, thinking about the peculiar situation, but usually monetary authorities would allow the currency to be determined by the forces of demand and supply, market forces, as it were. Is that an option on the table?
That's one of the options on the table. In fact, that's also a recommendation from multilateral financial institutions. And a number of observers locally have also been calling on government to ban or to disband the auction system and just allow the market forces of demand and supply to determine the exchange rate. So I think that's one of the options that could be announced by the central bank in the monetary policy statement.
Right, let's talk about Zimbabwe's debts. I know that the country is working with the African Development Bank, which says it has developed the financial tools needed to make over $3 billion in compensation payments to white farmers. So this is the issue of obviously settling the white farmers. But I wanted to just talk about Zimbabwe's debt stock overall and where it is right now and what the authorities are doing to address it.
Yeah, so the current debt stock is estimated at about 17.6 billion US dollars. So government is agreed with the development partners, the creditors, and foreign governments on. The government created what is called a multi-stakeholder dialogue platform on arrears clearance, which is bringing on board the key protagonists in the debt on the debt question in the country. So they've already agreed on reforms that must be implemented, and of course the government is also entering into a staff-monitored program with the International Monetary Fund. In fact, as we speak, the International Monetary Fund team is actually in the country. They're having Article 4 consultations with government, and they'll also probably then agree on the key benchmarks and deliverables under the forthcoming staff-monitored program with the International Monetary Fund.
Right. Let's talk about Zimbabwe's economic prospects for this year and the strength of ongoing economic reforms so far, especially on the fiscal side. I know that inflation still tops somewhere around 34%. Talk to us about the plan of this government to move the needle this year where the economy is concerned outside of the currency. Yes, a strong currency is important in the whole mix, but other factors like inflation, the cost of doing business for small businesses, boosting access to credit for small businesses, and ensuring that households are able to get the much needed credit that they need, and the cost of living crisis, which, by the way, of course, many other sub-Saharan African countries are experiencing. But, just helping to support households in the year.
So this year promises to be a more difficult year than last year. Economic projections in terms of growth for this year, officially growth is projected at about 3.5%, down from about 5.5% last year. So because of the El Nino event, we're expecting that agriculture will be slightly below the normal production. So that obviously then affects overall output in the economy. So because of that, we are also expecting that there's going to be a lot of pressure on food. So food prices may actually increase because of a decline, the projected decline in agricultural production. So that's going to affect a lot of households. And government obviously will then have to come on board, and also even seek for assistance from international institutions like the World Food Program. So this year, I think it's going to be slightly more challenging, especially because of the projected decline in agricultural production. But of course, government is moving ahead with reforms, especially around the ease of doing business. That's been a major challenge over the years. And of course, the increase in taxes is not help matters, because by increasing taxes, you're actually increasing the cost of doing business.
Right.
So I'm hopeful that at least with the elections out of the way, I think the focus for this year is going to be probably on the economy. So probably we're going to see a lot of economic and other institutional reforms this year since the election season is past.
Right. Well, Dr. Chitambara, we're going to have to leave it there, but thank you so much for sharing that insight with us, giving us a better picture of course, Zimbabwe's economic prospects for this year and what the authorities are doing to help support the local currency. That was Dr. Prosper Chitambara, a developmental economist. We'll take a quick break and I'll be right back with our international headlines. Join us again. International headlines now. Stronger than expected earnings have been leading companies on both sides of the Atlantic to announce share buybacks at a blistering pace as 2024 gets going, a potentially crucial pillar of support for global stocks markets already trading at all-time highs. While facing the highest borrowing costs in decades, corporations turned stingy on share repurchases in 2023, but that's changing with buybacks projected to increase this year. Profit growth is improving and investors expect the Federal Reserve and European Central Bank to start cutting interest rates this year. The reduced borrowing costs should give companies more cash and room to take on debt to boost their share prices. Elsewhere, the Japanese yen fell to a 10-week low today, while the dollar moved towards its fourth consecutive weekly gain as investors tempered expectations regarding the Bank of Japan's interest rate hikes and the Federal Reserve's potential cuts. Data remained largely unchanged at the Dow Jones. DTA remained largely unchanged at 149.39 per dollar after reaching 149.49 earlier. The yen is on track for a 0.68% weekly decline. BOJ Governor Kazuo Ueda suggested that accommodative monetary conditions may persist post the end of negative interest rate policy, or echoing dovish sentiments expressed by his deputy. Market analysts have cautioned against overreaction, noting potential intervention risks. And at the commodities markets, crude oil prices remained steady today, poised for weekly gains amid ongoing tensions in the Middle East following Israel's rejection of a ceasefire proposal from Hamas. Brent crude futures held at $81.62 a barrel, while the U.S. West Texas Intermediate crude futures edged up to $76.25 a barrel. The previous day saw both benchmarks climb about 3% as Israeli airstrikes targeted the southern city of Rafah, escalating the conflict in the Palestinian enclave. But these tensions have boosted oil prices, with Brent and WTI set to increase by over 5% for the week. Despite concerns, there's been no disruption to oil production. Additionally, deflation risks in China and increased output from non-OPEC countries like Norway and Guyana are influencing global oil prices. Those are top business international headlines at this time. We'll take a quick break. I'll be right back with our next conversation. Join us again. Well, thanks for staying with us. Welcome back to Business Edge. Earlier this week, at a meeting with lawmakers, Nigeria's Minister of Finance and Coordinating Minister of the Economy, Wale Edun, said Nigeria has turned a corner in its economic management. Now, echoing his sentiment, the Central Bank Governor, Yemi Cardoso, said positive outcomes were emerging from the Apex Bank's forex reforms. Meanwhile, in a bid to attract more portfolio investors, the federal government sold a record 1 trillion naira in treasury bills. That was on Wednesday this week, with yields on the one-year bill going to as high as 19%. Now, analysts say this is a signal that tighter monetary policy is on its way. Well, joining us for Macro Focus is Tilewa Adebajo, CEO of CFG Advisory. Tilewa, thank you so much for taking the time out to join us today. Good morning. Just wanted to get your initial thoughts of that meeting between the lawmakers earlier this week, who they have this debate series. It was the second they were putting together, where this time around they invited the Minister of Finance, the CBN Governor, Minister for Budget and National Planning, and of course the FRS to come talk about what their plans were for the year, and obviously targeted at just trying to get a sense of where the economy is heading and what revenue projections the government can look forward to. But I want to get your thoughts on some of the statements that the Minister of Finance did make. And he did say that the economy has turned the corner, saying that Nigeria's economic management is making that possible. What are your thoughts?
Well, I'm not sure about turning the corner. Inflation is still at 30%. If you take a look at the numbers do not reflect the fact that we have turned the corner. So I think it's important that while we're optimistic about what is going on, it is important that, yes, the reforms are in process, they're in progress, I think we should try to see what the first quarter results would be like, and then we can begin to understand why and if the economy has turned the corner. But in terms of the reform programs, yes, the reform programs are in the process of being implemented. And I think the strongest signal so far we've seen is the Treasury bill auction, where you have seen that the yield on the one-year instrument is now 19%, and the higher maturity instruments now have a tenure of close to 23%. So I think for me, this is a positive signal. This is something that the central bank should have done since October last year, so that we can begin to see inflation go down in terms of the tightening that they're proposing. But what is also important is that the yield curve is negative at the moment. So with this, you are trying to see that with the longer term maturities attracting a higher yield, you're now seeing that we're now on the way towards the yield curve being what I would say positive, which is very important because inflation is higher than interest rates, and that means that real rates and real yields are negative. So we're beginning to turn the corner in that perspective. So the next thing now that we're seeing with the MPC is that we're probably going to expect maybe a 700 basis point increase in the MPR from 18.75% now to at least 25% to be able to see a significant impact for them to meet the inflation targeting of 21% that they're expecting by the end of the year.
Well, that's a little aggressive, especially if that happens in one meeting. I suppose perhaps that could be across in the next couple of months. But also, that takes me now to the central bank. Well, the governor did also appear at that meeting, and he did make a couple of statements. And one of those comments was where he said that positive outcomes were now emerging from the country's forex reforms, which have continued to dominate our headlines. We have seen that shift, that gap between the official market, and NAFE market, and the parallel market gradually closing. So we're now somewhere around 1.4 at both the parallel, the official market and the parallel market. But what is interesting is the fact that we have seen an increase in transaction volumes. On February 5th this year, we did see volumes hit 844 million. The central bank governor says, look, this is one of the outcomes of the policy that the Apex Bank has taken, and we can expect to see the Naira beginning to stabilize. But what are your thoughts in the last 2 weeks, all the circulars that have come out, all the pronouncements, etc., the increase in volume, but where the Naira is right now? What are your thoughts?
Well, first of all, let me just say that considering the situation we're in, Treasury bill rates went up by 3 times. So it's not really aggressive. It's necessary because of the rate of inflation at 30%. So I won't really consider that as aggressive, more remedial, given the circumstances we're in. I'm a bit concerned about the fact that the net open book positions of the banks has increased the foreign exchange market rate. And I'm not too sure. I think we've seen highest volumes since 2022. So we've seen the highest volumes in the FX market for 2 years. So what that should mean for me is the fact that the market prices should go down. So the Naira should appreciate if you're increasing the supply. So the rates going up again, I'm a bit concerned because I'm still not seeing the price discovery, and I'm still not seeing the market forces at work. So I think it is important that the central bank governor promised us a while back that he was going to come out with a blueprint and a complete guideline for the new foreign exchange markets. And I think the earlier he does that, the better, because I think the market is still too speculative for me at this stage. And it is important that we restore order and control to that, which they have been doing, because I think we've now understood that the net open positions of the banks, they need to close those positions. It's not clear if that has been done. And the impact, at least on the short run, is the fact that the Naira should appreciate with those volumes of dollars coming into the system. It's not. And I think for me, that is a source of concern. So I think what is important now is for the central bank governor to come up with the blueprint for the foreign exchange market so that we understand how markets can move. Every market in the world has standards, same standard of movement price movements, caps and floors, and that's what we need in Nigerian foreign exchange markets. But I think the effort to bring in the INTOs and everybody into the same singular market, I think we can begin to see that there is significant amount of progress when it comes to that.
Right. Let's talk about the broader economy now. And I want to take you back to a comment that the finance minister made at that meeting, where he said that for this economy to get off the ground, for us to see traction, inflation needs to come down. And he also mentioned that one of the pressure within the CPI is the food index, which continues to put pressure and impact on inflation. The CBN governor did also allude to that. But if it's the food side of the CPI that's bringing in the pressure, we know why that is happening, because of obviously the farmers in the food belt of the country who are having challenges going back to their farms, banditry, insurgency, etc. Obviously, this is something that has to be fixed on the fiscal side and not on the monetary side. There's little the CBN can do if that persists. But what are your thoughts in terms of how the government approaches this, in terms of ensuring, we know that some grains are going to be released from the strategic reserves to crash prices, so that is said to will happen soon. But just your overall thoughts in terms of how we bring down inflation and tackle that supply issue from the food side of the CPI.
Well, let us understand the drivers of inflation in Nigeria. Food inflation is one of them, which is about 35%. The ways and means of 30 trillion is also a cost push factor. The current removal of subsidies, some subsidy on fuel pricing, and the continued increase is also important. And we need to remove subsidies totally so that government can get the savings that they require. So those are the cost push factors that are driving inflation in Nigeria today. And I think one of the things you need to do, first of all, is to tighten up, which is what we're seeing right now. So let's tighten up first and now begin to put in the policies to reach a target of 21%. So we know what the inflation drivers are and the cost push drivers of inflation. With food inflation, there's not much, like you said, there's an additional problem of security. So it's important also that the government should understand that the insecurity in the country is beginning to impact the economy, especially food security, adversely. So by releasing all these things into the right, what impact are you really going to make? It's going to be very minimal. And if you take a look at the timing of the release, this is not really the time. We're just coming through harvest. And at harvest, there's abundance. So this is not really when you have the price pressures. The price pressure will start around maybe August, July, August, September. That would be the best time to have released this food into the system, because that is when you have problems in terms of, the harvest has, all the stuff from the harvest from this year has been used and the new crop has not yet been harvested. So while it might be a good move, but at the end of the day, there's surplus of production in the system at the moment. But again, food security without a doubt remains a challenge that needs to be addressed. And that has to be addressed on the overall security infrastructure. So our armed forces, our security and intelligence operatives need to step up to resolve this issue of banditry, kidnapping, and all those things that are impacting the food basket, because the reason for this is not really economic, but it's a military problem.
But when you think back on the reforms so far, and what we've been hearing from the government is, there's still that time lag. We need more time for the outcomes of those policies to actually take root and begin to reshape the economy or get it off the ground, as the case may be. We've seen what's happening on the monetary side, the CBN trying to stabilize the currency and send a signal out to the foreign investors or FPIs, to help bring that dollar inflow back into the country. On the fiscal side, we're seeing the federal government, first of all, removing fuel subsidies, just trying to boost growth across different sectors. But when you look at the strength of the reforms right now, what is your assessment?
Well, like we've said, I think everybody will agree that the reform policies have been on mark. I think everybody will agree that these reforms are necessary. They're even about, some of those reforms are like the subsidy removal is close to 12 years late. So we all agree that the reform policies are noble, but I will disagree with some of the implementation. I think the implementation should have been done differently. The same reform program, but different method of implementation. The implementation for me seems to have been ad hoc, and there was a lot of false starts. And I think now, with the new budget coming out, I think maybe that synergy, that coordination between fiscal, monetary, and trade and investment policies are beginning to take shape. So again, I think what tends to happen with some sort of economic recovery of this now is that we need to see the sincerity and the commitment of the economic management team. So this is really now where the test is. The proof of the pudding will be now in the eating. So the sincerity and the commitment of the economic management team to stay the course, and for us to begin to see meaningful economic recovery, we're looking at a 12 to an 18-month period. So it is only after this time we can now begin to tell how this implementation has worked out. So, first of all, they need to stay the course. So if they're able to stay the course within the next 12 to 18 months, we'll begin to turn the corner around that point in time. And like I've always said, the parameters are very clear. If you keep inflation, the historical data is very, very clear. There's no ambiguity in it. If you put inflation between 12 to 13% and interest rates between 13 to 15% or lower, Nigeria's economy will grow between 8 to 9% per annum. I think that there's no doubt about that. So if you can move the inflation numbers and interest rates to a particular period, then there's no doubt that we'll achieve the growth that we require.
I wanted to draw your attention to and also get your comments on this headline I saw in one of the national dailies this morning, which says that the NNPCL board has approved the dollar revenue transfer to the CBN. I know that this conversation has been ongoing, especially thinking back to that time when the NNPC didn't remit to the national coffers over the subsidy payments and all of that. But now we're seeing the government trying to perhaps have a better control of what comes in to the coffers, and having the central bank itself sort of oversee that process to ensure that there's perhaps transparency. What are your thoughts on this?
Well, if you read that statement properly, it says a significant amount, not everything. So maybe you should check that statement again and look at it. So you see, we mustn't fool ourselves in this country. The NNPC revenues belong to the Treasury of the government of Nigeria, not to NNPC. And without a doubt, we have an account with the JP Morgan Chase. We've had that account for decades. So I think NNPC should go back to that account, which is being held by the central bank, and ensure that every single penny from oil proceeds, first of all, goes into that revenue account. Then, as a matter of policy, NNPC can now maintain operational accounts at the central bank or whichever account it chooses to. But all the money from oil proceeds should go into a dedicated revenue account of the federal government of Nigeria within JP Morgan Chase. Then you can now begin to talk about other operational accounts that could be opened, and the transfer of money that is due to NNPC to those other accounts. NNPC should not be the one deducting money from revenue and sending it to the Federation account. It's the other way around. And I think that is a travesty of Nigeria, and that is one of the problems we've had. So that money belongs to the Federal Ministry of Finance and should be domiciled in the Central Bank of Nigeria, JP Morgan Federation account. That's the way it's always been. That account is as old as, you don't know, that account is so old. Maybe they opened that account from the 1970s, from the days of Chase Manhattan Bank. So let's go back to what we used to do. There's nothing new here. There's really nothing new here.
All right, Tilewa, I must thank you for your time today. Thank you so much for sharing all that insight with us. We do appreciate your time on the show today. That was Tilewa Adebajo, CEO, CFG Advisory, looking at, of course, Nigeria's authorities betting on ongoing reforms. With that said, on this edition of Business Edge, remember to follow us on social media. We are at News Central TV. For now, it's bye for now.